hypnotized by the sounds I'm breathing in. Hold tight, hold tight.
Hey guys, what's going on? Nick Foy here, the founder of under30wealth.com. I'm a real estate investor and real estate broker by day, and at night I like to come home and share as much free knowledge as I can on my YouTube channel. So if you're new here, go ahead and hit that subscribe button. We come out with weekly videos, so you're going to find lots of helpful content to help you get started investing in real estate. So I got started at age 20 buying a single family home in a normal neighborhood. It's just a house. That's what single family home means. So I bought a house in a neighborhood. We fixed it up and we ended up renting it out to a tenant for a little over a year. And then the tenants wanted to buy the home, or they were considering moving out and finding somewhere else to live. And at this point, we decided it would be a good decision with my business partner and I to sell the property to our tenants. So we threw out a purchase price that we wanted to get for it, and they accepted. So we went ahead and sold the property to them on land contract. So that means that we took out seller financing. So they paid us a down payment. We're carrying the loan. So every month they're paying us the mortgage payment. And if they would stop for some reason, we would have to notify them and then go through the legal proceedings of foreclosing if it came to that. But over the next 3 years, they're going to be paying us mortgage payments, and then our note will come due. They'll have to then go get a loan from the bank to finish paying us off, or else, like I said, if they can't, then we got to go through some legal procedures. But that was a successful transaction where we ended up selling the property for about a $75,000 profit. And then we add in all the rental income profits that we made from renting it out. And then you factor in all the interest income we're going to be earning from the mortgage over the next 3 years. It's going to turn into a six-figure deal because you're going to add another 25, 30, 35,000 from all that rental income and all that interest income from the mortgage on top of the $75,000 in flipping profits. So that first deal that I did at age 20, that ended up turning into a six-figure deal, which is pretty cool. And it was cool that like once we sold the property, all those funds would have just came into my bank and sat. So at least by doing the seller financing, we reinvested those funds in a way to keep growing our money, keep it reinvested. So now we're earning interest on those funds. And in the meantime, our extra funds that I had that I was waiting to put to use, we ended up finding an apartment building. So at age 22, I bought a multifamily apartment building, and it has commercial space in the downstairs basement. So that's what today's video is going to be getting into, is talking about multifamily apartments, as now I have experience actually investing in apartment buildings. So let's go ahead and run through the presentation on multifamily investments, also known as apartments. So first of all, it's a residential investment, meaning that people are going to live in it, whereas commercial is more like offices, companies, businesses. So that's the difference between commercial and residential. Some people call apartments commercial, others call them residential. But one general term everybody agrees on is it's called multifamily because multiple families live in the property. All right, so we just covered what is multifamily investing. It's basically just buying an apartment building that's got lots of different families living in it. So you've got multiple people paying you rental income to help support the costs of that property. So let's first talk about the costs of a multifamily property. So property taxes, property insurance, these are pretty standard. Of course, if the building was to burn down or get hit by a hurricane or a tornado, you'd want to have property insurance, protecting you there. We've also got property taxes that are mandatory to pay, and you can look up property taxes in the public records. If you don't pay your property taxes, then they could get a lien placed on the property and you could get foreclosed and lose the property. You also will have utilities. So these are going to be your common area utilities. So if there's hallways in the building, you're going to have to pay the electricity to keep those hallways lit. Same with parking lots if you've got lighting to light up the parking lot at night. So, and then you're going to have the water, the sewer, you might have trash service. So there's these different utilities you're going to have to pay for the apartment building. And then tenants can be responsible for their utilities in their own individual apartment units, but you're going to have to be responsible for the common areas. You've also got maintenance expenses, especially on multifamily properties. So if it's got a parking lot, you're going to have to pay a company to come in and do snow removal. If you're living up north, if you're down in the south, you're going to have a lot of lawn care all year round. Same with up north, you'll have lawn care, snow removal. So you've got these different maintenance expenses. If there's a pool, you're going to have a pool company come in and service the pool. If you've got, window companies that come in and wash all the apartment windows, or repairs to the parking lot, every year maybe they repave the parking lot and have lighting issues. So there's going to be lots of different maintenance factors and repairs that you're going to have to worry about that's going to add to the expenses of owning a multifamily property. And then lastly, we've got property managers. So if you decide you want this to be a passive investment where you don't want the headaches of having to go to the building every day and manage the whole process, going there to meet contractors, going there to collect rents, going there to deal with tenant disputes. If you don't want to deal with all that, you can hire a property management company or a solo property manager. Sometimes real estate agents will do property management on the side. So depending on how big your building is will determine what kind of resources you're going to need from the property management team. And then evictions, we go ahead and throw those on there because those are technically expenses. If you've got uncollected rent, you're missing out on income there, so that's an expense you have to project in. And once you evict somebody, you're going to have vacancy. There's going to be units that aren't producing rent, so those are going to subtract off your gross potential income. So next, let's talk about the rental income of multifamily property. So it's good to know your market. So for example, if you've got an apartment building downtown and there's 5 other apartment buildings downtown, you got to consider your apartment units compared to theirs, because tenants are going to be stopping by all the different apartment buildings downtown, checking out the different units, checking out the rental rates. So you want to be competitive with your competition. So it's good to go into these other buildings and pretend you're a customer, or you can give them a phone call, or you can just look up online. Sometimes they've got the units listed for rent on the internet. So you could figure out what kind of units your competition are renting out that potential tenants might choose over your building. So it's good to figure out what market rents are. So if you're running if you've got, let's say 10 one-unit apartments, and you've got 20 two-unit apartments, and then 20 three-unit apartments in a 50-unit building, you've got to understand that each of these different units are going to rent differently since they've got extra bedrooms or bathrooms. They might be different square footages. So you got to go around and find comparable rents. So in another apartment building, you might see that the studio apartments are renting for $900, $850, and $925. So that gives you a good ballpark that you should be renting out your studio apartments somewhere between $850 and $925. And then you can look at the condition of your units and compare to the other condition of the other units. Are they higher end, with granite counters and nice appliances in the studios? Or are they more average, kind of, less expensive studio apartments? So you can compare the upkeep of those units compared to yours. And if you need to go in when you buy the building and make renovations to get up to speed, up to the condition of these other units that your competitors have, then that's going to get factored into your costs of acquiring the building. How much is it going to take to renovate the building and get it up to an acceptable condition to where you can raise the rents and charge higher rents? Because if you leave the units outdated and not looking nice and new and updated, then you're not going to be able to raise rents and charge higher rents, because tenants won't want to live in those lesser quality units for the same rent that they could be paying at another building that's got nicer units. So it's good to do your research of your competition, figure out how your building is compared to theirs, and from there you can start setting the rent prices. If you notice that rents are $700 and you can get $900, then you have $200 you could raise the rents after doing some renovations. So that can factor into the analysis of your return on investment. The building might be producing a 10% return right now. After you raise rents $200 a unit, you might be bringing in an extra $5,000, $10,000 a year, which could raise that return up from 10% up to 15%. And that's how you create value in apartment buildings, is by increasing the net income of the property. So that's what we're going to get into shortly. We've got to look at the condition of the property, age of the building, the condition of the units, the size of the units. You're looking at the number of bedrooms and number of bathrooms. When you figure out all these different things, you'll be able to better analyze your building versus your competitions to figure out what kind of rent you could set at that you think tenants will want to come to your building and rent from you versus going somewhere else. Now, to analyze the numbers, let's talk about valuing the building. So here we start out with rent. So let's say you're able to collect $9,000 a month in rent from the different units in your apartment building. So that works out to $108,000 yearly when you multiply it by 12. Then you've got property taxes, insurance, you've got a repair reserve that you've got to set aside so that when repairs come up, you have funds available to take care of those. You also have to consider all your maintenance services every month that we talked about, lawn care, pest removal, snow removal, the different services, the pool. Then we've got the property manager as well. They might be charging 1 month's rent. So if you're collecting $9,000 a month in rent, you might have to pay 1 month's rent to the property manager. So that works out to about $750 a month, $9,000 a year. And then you'll be able to subtract all those expenses to determine your monthly cash flow. So in this case, after all those expenses, our example produces almost $5,600 in cash flow, which works out to about $68,000 a year. So from there, you can look at what the building's currently doing, and you can go in and figure out how you can improve things. If you can raise rents, if you can cut down expenses of the property, that's going to increase your net income, and that's what the building is valued based on. So that's how somebody else is going to determine the purchase price that's going to be buying it from you. They're going to be looking at the net income, and that's the same when you go to buy a property. You're going to look at the net income, and you're going to use a cap rate in the local market to determine what the property's worth. So the cap rate is simply the net income of the property as a percentage of the property's value. So it's just called return on investment if you were to buy the building all cash. So for example, if your building has a net income, of $68,000 like we just talked about, and you see that the listing price is $680,000, then the cap rate, you could do the math real quick. What would that cap rate be? So it'd be 10%. You have $68,000 in net income. You invested $680,000 into the property, so every year you're making a 10% return on your investment, and this is what is called the cap rate. So when you're going in to buy the property, you want to buy obviously at a higher cap rate. That means you're getting a bigger return on investment. You're paying less for the same amount of income. So if you're able to buy the property, for example, for $600,000, $500,000, and make $68,000, and then let's say you turn around, fix the income up, and get it making $75,000, you turn around and sell it at a lower cap rate, that's going to make the building value a lot higher. So you might be able to sell it for $1 million, which would, if you're making $70,000 a year and you're selling it for $1 million, that would bring the cap rate down to a 7%. Because 70,000 divided by $1 million purchase price, that would make a 7% return for the investor coming in. So cap rates, you want to buy high going in, you want to sell low going out. That's going to help increase the value of the building. So here's some different examples of return. So if you're able to buy at a 20% cap rate going in, you could buy that $68,000 of net income for $340,000. And then if you were to fix the place up and sell out at an 8% cap rate, you could sell the building for $850,000, meaning another investor is willing to come in and pay $850,000 to get a $68,000 return on his purchase price, which would work out to an 8% return for him. And that might be a good deal to another investor because maybe, in the bond market, he's only making 2 or 3%. In the CD market with banks, he might be making 1%. The stock market might be negative or making him 5, 6, 7%. So if he's able to make a higher yield through real estate, this looks like a good deal to him. He'd be happy to come put his $850,000 to work and earn 8% on it rather than, putting it somewhere else where he's making 5, 6%. Whereas if another investor might come and say, I only want to do this deal if I'm able to make 15 or 20%. So in this case, they're going to try to buy distressed properties that they can buy that need a lot of work done to them. So the seller is going to have to sell at a lot cheaper price, $340,000, $450,000, because the property needs lots of work. Maybe it's got lots of vacancies. So you could go in, fix the place up, sell it at a higher, valuation at a lower cap rate to another investor who just wants to come in, buy a property that's already running smoothly, that they don't have to worry about fixing up. They want those Class A properties where you could be the investor that goes and buys a Class C property, fixes it up, and makes it turn into a premium Class A property. So that's kind of, talking about the return on investment and how to calculate for apartment buildings. So again, you would go in, maybe you're buying it right now at $340,000. It's only producing $68,000 of net income, and it's got lots of vacancies. It needs lots of updates to the units. So you go in, you stick in another couple $100,000 into the building to renovate it. You raise rents, you cut expenses. Now you get that cash flow up to, let's say, $100,000 a year, and you turn around and sell it at a 10% cap rate. So $100,000 would be a 10% return on $1 million valuation. So now that building's worth $1 million. So you bought it for $340,000. You put a couple hundred into it, so you're all in it for maybe $500,000, $550,000, and now you're turning around and selling it 5 or 6 years later for $1 million. So you're going to profit big money. So that's how people get rich through apartment investing. They buy it low, at a low purchase price at a high cap rate. They fix it up, get the net income up, and then they sell out at a low cap rate, which puts the purchase price a lot higher than what they bought at, and they're able to make a big profit there between what they bought and what they sold for. All right, so to figure out cap rate, that's probably your next question. How do I know what the cap rate is in my market? Well, you got to find market comps. So all you got to do is go talk to a commercial broker or a residential broker. I would get opinions from both. Commercial brokers, they deal with buildings, offices. They also deal with multifamily buildings, mixed-use buildings, and then residential real estate agents, they deal with multifamily property and single-family property. So get both opinions from both to kind of compare. They should give you similar statistics of the market if they're both going into their database, pulling information. So you want to know for A class, B class, and C class buildings. A class is obviously like your premium, really good office space or apartment buildings that are downtown. C class, that might be properties in the hood where there's lots of crime and violence and drugs and stuff like that. So you've got some different classes here of how they determine real estate. This is kind of your lower quality, mid quality, and high quality. So figure out what cap rates are for each of these. I think our apartment building we just bought would be considered a B to C class, but we're trying to fix it up, make it nice, get a good tenant in there to turn it more into like a B class / A class property. But going in, you always got to go in and buy it kind of in a distressed condition, but it's more so the location. If you're buying it in a really bad location in town, that's probably going to get dubbed a C class building. So here we go again, talking kind of about cap rates versus risk. If you see a property selling at a high cap rate, like we said, 20%, where the purchase price is really low compared to the net income it's producing, giving it a high cap rate, then that probably means that there's some risk involved with the building. So there's probably some vacancy, lack of income. So you're going to need to go in, get those units fixed up and rent it out to get the property occupied at 100%. And there's probably going to be lots of repair expenses with the property. You might need a new roof. There might be some terrible leaks, some mold. The elevators might not be working. There's probably some major expenses that you're going to have to come out of pocket to repair to get the building back up into good shape that makes people actually want to live there. If people feel like they're living in a slumlord building, that's going to be hard for them to want to stay. You're going to have people moving out. You're going to have other people who won't want to pay those increased rents if you try to raise rent on them because they'll say, it's not worth the condition of the property. So you want to give people a good place to live. So expect to spend a good amount of money fixing up a distressed apartment building. All right, so that wraps up today's video on multifamily investing. If you found these slideshows helpful, make sure to give it a thumbs up, hit that subscribe button, and turn on notifications so you get notified when we upload weekly videos on real estate investing and building wealth. I want to help you guys get started in real estate, taking income from your job, saving it into a bank account, and eventually accumulating enough money to make a down payment on a real estate investment property or buying it all cash But being able to start building wealth through real estate will quickly change your life and allow you to quit your job if that's what you're going for, or it will give you a nice padded retirement savings so that someday when you decide to leave your job, you'll be taken care of in retirement and you can go buy those fancy toys or those vacations you've always wanted to do with your family. So, hopefully my videos can bring a lot of value to you. Like I said, we upload every week. So make sure to go check out as many of them as possible to grow your knowledge as much as possible, and then get out there, start taking action, and let me know, the success you guys are having, what kind of deals you're buying, what's going on with them. I love to hear feedback of different properties you guys are doing. So let me know in the email, nick@asknickfoy.com, or you can email me for Under 30 Wealth, nick@under30wealth.com. I got 2 different websites there, 2 different emails set up. So let me know how you guys are doing. If you have any questions, I'd love to help. And be sure to check out my real estate investing course. It's the first link in the bio. Take care.